race or minority communities. And there's probably no other area where you ought to pay attention to changes in the jargon than housing policy. So what was considered an undeserving population that shouldn't get any mortgage capital was redefined as underserved, right? So markets don't create themselves. They're created by human activities, and I think this is really something to pay attention to. The bottom line with this is that so-called underserved markets and people were basically a profit opportunity for the lending industry. The mortgage market for suburbs and other places is saturated in the 90s. But this gets all cloaked up around, hey, we're providing the American dream, right? Owning a home and all this stuff gets wrapped up in something called the American dream, and maybe, you know, the definition of American dream is owning your own house. But remember, we say owning, but it's not really owning, right? Only a third of the people who are in owner-occupied housing have paid off the mortgages. The rest of the people, including myself, are borrowers, right? We don't own our homes. The bank owns the homes. But, you know, the second someone gets a mortgage, we say, you're a homeowner. And that's kind of not something, you know, that's an interesting twist. Bottom line is exploitive, targeted lending practices produce super profits, commissions, and salaries. I will show you, examples of how money is churned through the housing market. It's extremely profitable. Really, as I have thought about this over the years, you have an incoherent policy coupling. You have home ownership as being your sole housing policy, really, but then you couple this up with deregulation of mortgage markets, and you have high-cost mortgages. So somehow we decided, hey, we're going to promote home ownership. The way we're going to do this is by charging more for mortgages. So somehow, through this alchemy, really, lower-income people were supposed to benefit from expensive, often predatory loans. So this is, kind of a policy that maybe didn't make that much sense, but it's based on the erroneous notion that housing prices can never go down, which wasn't true during the boom and is obviously not true now. There's another piece to this, and I think the research community in many different areas is implicated, because the housing policy research community touts the benefits of home ownership, yet when you really look at the literature on the alleged benefits of home ownership, you find they're very poorly supported by empirical research. So there's all sorts of ideas that we have about home ownership, creating better citizens, doing this, doing that, and the other thing. But when you really look at the empirical research, you find that a lot of that stuff is basically unsupported. And so if you make policy based on either non-existent research or inadequate research, sometimes you end up with bad policies. So there's a linkage there. In terms of the housing crisis, ruthless lending practices expose borrowers to multiple risks. So we have exotic mortgage products, option arms. What's an option arm? It's an option adjustable rate mortgage. Bottom line with this is you decide what you want to pay each month. So you can make any payment you want on an option arm, right? Which means that over time people would actually have a balance that's going up, right? That's contrasted to what we consider the kind of conventional amortized mortgage, right? Where you pay a certain amount of principal each month and a certain amount of interest each month, and by the time you pay for 30 years, you've paid your entire loan off, right? That's the conventional mortgage product that's developed in the Great Depression and works pretty good for 40 years. Option arms means you borrowed $200,000 5 years ago, and now you owe $300,000 5 years later, right? Non-documented loans, we call these liar's loans. These are loans where borrowers are not asked to actually provide evidence of income, employment, or anything like that, right? And often we find there's fraud involved in these loans. So I know of people who a guy makes $36,000 a year, and he managed to get a $400,000 mortgage. And when we looked at his mortgage documents, we found that the broker had written in that this guy was clearing $16,000 a month in order to qualify him for a loan. And in fact, in Minnesota, we passed an anti-predatory lending bill, which we had to say, you have to verify borrower's income. Right? We had to have a law to do that. And by the way, the federal government at the time ruled that state laws do not apply to federally chartered institutions. So actually, you can still do this today. Okay? We had NINA loans. These are called no income, no asset loans. Okay? So the thing here is money is flooding into the housing market because securities are so profitable. What is happening is they're saying, find us borrowers. We need borrowers so we can create more securities because they're so profitable. So this is many things about this is are very counterintuitive. Other things that cost people are bearing are healthcare costs and also education costs, because we all know that the cost of education has greatly increased, and there's a scandal out there waiting to happen because there's billions of dollars of subprime student loans sitting out there too. So let me show you some maps here. This is foreclosures by state. 3 states account for a large proportion of the foreclosures: Florida, California, Arizona. But Illinois has a relatively high prevalence of foreclosure. And I think right now we're looking at that 1 in 80 housing units has had or is having a foreclosure action on that housing unit. Nevada, in terms of proportion of foreclosures, of course, leads the country in that. And I think that's 1 in 12. 1 in 12 housing units in Las Vegas is in foreclosure. I could say something about gambling, but I'll skip it. Now this is a map is a little hard to read. This shows mortgage delinquency. This is a map showing what proportion of loans are actually 90 days past due. So this is kind of like the future foreclosure map, right? Normally, mortgage delinquency runs at less than 1% of all loans. And right now in the country, it's about 8% of all loans. This doesn't sound like much, but it's gigantic. In the subprime option arm sector, 55% of those loans that were made are currently delinquent. And so this delinquency